Right, so the next problem we'll do is exercise 13-17, and in this exercise we're going to actually create a statement of cash flow from a set of given information. There's lots of little extra steps that we have to do in here because we're not just given the information that we need verbatim. We have to figure out some of the items using things that we learned in previous chapters. So one of the first things I like to do is to make sure I know where my beginning numbers and my ending numbers are. So I usually like to draw some arrows just so I know I'm going from whatever that would be, year 1 to year 2, and I'm not doing my changes in the wrong direction. So we've got our partial balance sheet here, and then we've got some additional information, and then we've got all of these descriptors. And what we want to do is prepare our statement of cash flows using the indirect method. So remember there's two methods, indirect where we adjust our accrual numbers to cash flow, and then the direct method where we just start all over. Remember that GAAP requires the indirect method, so that's what we're going to focus on. So just be aware that the direct method exists, but don't pay too much attention to it. Alright, so the first thing that we need to do is put our date for our statement of cash flow. So it's as a period of time, so it's for the year ended 12/31, and then we're calling it year 2. We are always going to do our statement of cash flows in the same order: operating activities first, then investing, and then financing. So when we're doing the indirect method, our cash flows from operating activities is always going to start with our net income. Okay, so if we look at our supplied information, we're not told what our net income is. So we need to figure it out. And the way that we can do that is by drawing a T-chart. When in doubt, draw a T-chart where you see that number. So with the information that we're given, if we use our retained earnings T-chart, we can figure out what our net income is, because remember what affects retained earnings as beginning and ending retained earnings, net income, and dividends. So from our given information, we know that we start retained earnings with 438 and we end with 476. And then they also tell us that we debited retained earnings for cash dividends declared of 24. Now remember, I knew to credit retained earnings because it's a stockholders equity account. Normal balance for stockholders equity accounts are credits. Okay, so we know if we start with 438 and then we pay out 24, we're not going to end with 476. So we need some credit right here. And what that credit will be is our net income. So if I want to figure out what my net income is, I would do 438 minus 24 plus my net income equals my ending balance. So I would get net income of 62. So I can go back up here and fill in my net income for 62. Okay, then the next thing we do in our operating section is changes in current assets and current liabilities. Oh, they're going to do those down here. So two things that you'll always have is to add your depreciation expense. Always add it back. We'll never subtract depreciation expense on our statement of cash flows. So once again, they didn't tell us exactly what our depreciation expense was, but we can figure it out. Once again, we're going to do this by using a T-chart, and where our depreciation expense goes, when we do our journal entry, it's depreciation expense debit, and then our credit is to accumulate depreciation. So if we look at that accumulated depreciation account, we can figure out what our depreciation expense for the year was. Remember, accumulated depreciation is a contra asset, so its normal balance is going to be credit. We started with 42, we ended with 68. Okay, so in this example, we didn't sell anything, but if we had sold something, we would need to take that into account. So I would need to, because that would come off the books when I sell something. So we don't have that in this case, but you could. So once again, 42 to 60, I need to do a credit, and the credit will be for 26. So that would be my depreciation expense. Okay, now the other adjustment that we need are gains or losses. So for this one, they tell us that we sold land for $120 and tells us we didn't have any disposals of equipment for the year, so we don't need to take that into account. So once again, we need to figure out if we have a gain or a loss on that sale of land. Okay, so once again, I'm going to draw a T-chart. I'm going to draw my land T-chart. Okay, so they tell me that I started the year with 330 and I ended with 250. So that means that the historical value of the piece of land that I sold was $80. However, they tell me that I sold it for $120. So the value of it was 80, the value of it on my books was 80. I sold it for 120. So if I compare those two, that tells me I have a $40 gain. Okay, so now to figure out what we do with that on our statement of cash flow, let's think about it. So a gain will increase my net income, but the cash is accounted for in the investing section because it's a long-term asset. So we need to take it out of net income to get back to cash. Okay, so if we go back up here, we're going to minus the gain on sale of land. So the opposite's true. If it was a loss, the loss would have decreased my net income, but the cash is already accounted for elsewhere, so I would have needed to add it back. Okay, and then everybody's favorite section, changes in current operating assets and liabilities. So if we go to our partial balance sheet, the first current asset that we need to consider is our accounts receivable. So we went from 49 to 55. So we had an increase in my accounts receivable. What does that mean? Of 6. So it tells me that if I increase my accounts receivable, people are putting things on credit, but they didn't pay cash for them. So it would have increased my net income. So in order to get back to cash, we need to take out that increase. So I'm going to make that a negative. So in the PowerPoint slides, you'll see a summary slide about what to do with increases in current assets and current liabilities and what to do with decreases. Make sure you can logic your way through one current asset and one current liability, and then if you can do that, you can apply that to all of the other ones. So the next thing we have is an increase in inventory. So once again, that's a current asset, so it's going to move in the same direction. If my inventory increases, I need to take it out, because it overinflated my net income for the cash. Okay, and the last current asset or current liability I have is an increase in accounts payable, which is a current liability. So if my accounts payable increases, that means that we didn't pay cash for all of our expenses, which decreased our net income. So because of that, since we didn't pay the cash, but it decreased our net income, I need to add it back to my net income to end up at cash. So we see that current assets and current liabilities work in opposite directions. Okay, so we finished our operating sections. We have net, cash flow from operating activities. And if I add all of those together, I get 38. Okay, so our next section is our investing activities, and remember these are long-term asset items. Okay, so we already kind of talked about one of them, which was the sale of the land. So if I sell land, that means I'm going to receive cash. So cash received from sale of land. And remember in our investing and financing sections, we do the actual cash value. So I got $120 of cash for that sale of land. Okay, so the next thing we have is equipment. And if we look at our balance sheet, we see that we went from 175 to 205. So if we go down here and we go to equipment purchase, so we have equipment. So we started with 175, remember it's an asset, so normal balance is debit, and it ends with 205. So one key piece of thing is that it says that there was no disposals of equipment during the year. So if there was, they would show up here, but we had 0. So in order to get from 175 to 205, it would be a $30 purchase. So cash paid for purchase of equipment. Since I'm getting equipment, I'm paying out cash. And if you look at our balance sheet, those are our only 2 long-term assets. So we can finish out our investing section. So we have net cash flow from investing activities, and we get 90. Okay, last section is our financing section. So remember, these are long-term liabilities and stockholders' equity. I guess I should put up here current assets, current liabilities. Okay, so the first thing we see is that we have a change in our common stock for the year. So in order to figure out what that balance is, if we come down here and let's look at our common stock. Okay, so the first account we have is common stock. So we started with 80 and we ended with 125. So that tells me the value of the stock that I issued was the par value of the stock that I issued was 45. However, we also have an additional paid-in capital account for our common stock. That started with 70 and ended with 85. So we can see that shareholders paid more than the par value for it. So the total cash received for my common stock would be the sum of those two. Okay, so we go back up here. We have cash received from the sale of common stock, and it would be 60. Okay, so if we keep moving down, if we look at our additional information, it tells us that we had some things happening with our dividends. All right, so remember, we're only going to consider cash dividends here because we're in our statement of cash flow. So once again, if we look at our T-chart for dividends payable, we started with 24 and we ended with 5. So that means I had to have a debit in order to get it out of a payable. That means I actually paid the cash for it, because it would be debit dividend payable, credit cash. So we would have cash paid for dividends. Since it's cash paid, it's going to be negative. And those are my only financing activities. So we have net cash flow for financing activities, which would net to 41. So if I add up my three sections, I will get my change in cash. So it would be the 38 plus the 90 plus the 41. If I add all of those together, I get 169. And I can do a quick check. My cash at the beginning of the year that they told me on my partial balance sheet was 14, and at the end of the year was 183. And if I look at that change, it is 169. Okay, so one last little part to this example. It asks, was Olson Jones's net cash flow from operations more or less than net income? What is the source of the difference? So the cash flow from operations was less than the net income. If I go back up here, I see my income is 62, but my cash flow from operations is 38. So cash flow from operations, 38 is less than net income of 62. And why did that happen? Well, I had a gain on the sale of the land that I needed to take out. I had changes in current assets and current liabilities. And then I also had depreciation expense to take into account. Maybe I should circle them. Okay, so these are the ones. Sale of common stock. No, it's a stockholders' equity account, so that would be financing. Purchase of equipment, that's a long-term asset, that would be investing. And then dividends paid would be stockholders' equity, so it's financing.